Well, good day all. Ira Epstein of Linn Associates with your financial market wrap-up for this Wednesday, and we're at the 3rd of April, 2019. You know, I was watching today at the end of the day, CNBC, the market wrap-up that they have. Wow, are they all bullish on that show? I mean, when I see everything so bullish, I get a little nervous. I mean, they're talking the Shanghai index going up a couple hundred percentage points from here. I was just watching it, so it's fresh on my mind. Stock market can run, jobs report data coming out on Friday. I do admit one thing. The market has gone back up in a dramatic fashion from Christmas Eve to dramatic highs here. It has not consolidated. I give ground on that as well. But the fact that everybody's just going to jump in here without any consolidation, it just keeps going, I'll let that for you to decide. When we take a look at what you've got going on in the stock market, it's nothing short of just what people are saying. It's an unbelievable rally. You've gone from 24.85. First of all, the question is, should this break in December? What was the cause of it? That's the first thing. Number two, it's all gone. The market's gone through that level of it. You're approaching, if on a closing basis, 29.34 is the all-time high close. We are now in striking distance of that, in round figures, 60 points away. When you take a look at the chart action, you've gone in waves of no consolidation to speak of, maybe 3 to 5 days at a time going sideways. I don't call that much consolidation, up right on where you're at. And by the way, I'm not complaining about it. I'm just describing what the chart action is. When we take a look at the patterns, remember I said this was a crazy pattern here. You had an outside day up, then you took out that day's low, and instead of getting a big break out of the market, it was extremely shallow, and it set up within 5 days another buy signal of that. Pretty strong. It's all happened there against the 18-day average of closes. Never did get down to what we'll call lower Bollinger Band. You didn't come back and retest since March, the beginning of it, and that's not that far away, the 200-day average, but it was a fleeting moment. And now you've been challenging on a regular basis the upper Bollinger Bands. Regardless of how bullish you may be or TV announcers want you to be, the one thing I'll stick with is what I know. And I don't have my clients buying upper Bollinger Bands or selling into lower Bollinger Bands. It's that simple. That's what I teach in my charting course, and I do my darn best to espouse that. Period. That's where it ends. So yeah, I see an uptrend. I see a market that is overbought. Could it embed? You got it. If it does, then I change my opinion. Not to buy Bollinger Bands, but what I think the pros will do on the breaks. Now, it was interesting today because 2 to 215, the market broke in the indices and went back to basically unchanged on the day. And looking at TV, because I was doing other things, I was going to do a special report on stock indices today, actually, and got torn away from that. Then BNN TV, Bloomberg TV in Canada called, and I did a show for them. And to make a long story short, before I left, I'm watching the Chinese pictures of the Chinese delegation for trade arriving at the White House and how our negotiators are out there greeting them. And it wasn't the way it was before. No stern faces, smiles on everybody's face. The Chinese side, I haven't seen that before. And with that, the market turned around and had its rally. So it's a bull market that is in need of feeding. That's number one, and most bull markets are, and it's getting the necessary food at this point in time. That's probably the best way I can sum it up. Will the market embed is where I'd be on a holding point looking to see if that occurs. And because it's only day one of it today, it means you get to see the jobs data on Friday to know, assuming tomorrow's a strong day, if it's going to embed or not. And that jobs data will be interesting because some people will say, well, that dispels the notion, if it's strong data, of the inverted yield curve. And if it comes out poor, that whole idea that's been forgotten, and it should be. I mean, just because you get an inverted yield curve, the market doesn't fall apart the next day. It's an indicator of over time something. We'll see what goes on. In the NASDAQ, you tell me where the market went to and finally stopped out. Now, it's been another vertical price rise with a lower low, higher high. But each time you get up there, you seem to run into an area that at least restrains the market or throws it back a little bit. You're also overbought, and unlike the S&P, cannot begin that embedding process because both numbers aren't over 80. Same thing in the Dow. You're at the resistance. Now, in the Dow, you could be in for a bit of a trap here, too. If you look at the pattern, if you take out yesterday's low, which was 26,126, today's high of 26,302 did take out what number? It took out the high up here. You've got to always look at your numbers because sometimes on charts, one of the numbers doesn't look as high as the other on a bar, but it did. So if you were to take out 26,126, you could start a correction, but it would not be bearish in the sense of lower highs, lower lows. Do we understand that? In the Russell, the market seems to be climbing this wall to get up to the upper Bollinger Band and the 200-day moving average. It is overbought in the process. So I leave everybody to their own way, but I see resistance here. I see resistance at the Bollinger Band up here. And the one thing I do not teach, and that's what you have me here to do, is tell you to be consistent with using your indicators. Either you believe in them or you don't. These indicators aren't saying go short. They're also saying, you don't buy that Bollinger top. That's all that it says. That's what I teach. It doesn't mean if it's right or wrong. That's what I believe. If we look at the VIX, unable to make it to that lower Bollinger Band, and where's it going? Right back to that 18-day average to try to figure out what to do. But in the process, it had an outside day up. So now you have higher lows, higher highs. Well, the VIX shouldn't be falling if you're going to get a rise in those stock indices. That's one of the things that I'd look at. Number two, you're very oversold. If the market would have closed over the 18-day average, which it did not, the bias would have been up. So I have a market that's neutral. The swing line's up, but the bias is down, so they neutralize each other in an oversold condition. In the T-bonds, here's what we were looking for. If you look here, this was an embedded reading. The numbers were all over the 80 level. Got it? When you lose that reading, unless the very next day it's grabbed back, and I mean right away basically, the odds are going to favor price and the 18-day average are going to make a strong run at each other. Do they have to hit? Well, if I knew that every time they'd hit, you wouldn't see me. I'd be the richest man in the world. But it's what the odds favor. So I'm looking at this market to go back down to the 18-day average. It's exactly what it did today. So now I'm going to call this market on the close. Close 147.16. 147.18 is the 18-day average. I've got lower highs, lower lows. I closed under that number. Momentum's pointing down. You're in a bear trend unless you take out 148.23. In the 10-year note, same play. You had lost your embedded reading. I think you'd agree with that. Did not hit the 18-day average. Did not hit it. Bounced up. I'd be looking to see, can you get to that 18-day average of closes? It's exactly what the market did. It closed under it by a tick. A tick is a tick. So now you've got lower highs, lower lows. The trend is down. If the market's going to continue with the downtrend and momentum down, in play is possibly the lower Bollinger Band and the 100-day average. Where's the resistance in this market? The 18-day average. And you break the downtrend if you take out right here the 123.27 level. If we come back to the bonds, if it continues down, the possibility of there. Resistance right here at the 18-day average temporarily, and you break the trend if you take out that high. In TLT, you had done what? Let's see if I can bring this back. There we go. This should do it. There we are. Here you have a market that loses its embedded reading. Market gets a bounce here. If it's going to do what I teach, the odds favor. Doesn't mean it's going to happen. The odds favor price and the 18-day average now making a run at each other. You tell me what happened today. It's exactly what I'd be looking for. And I think traders went flat on it today. Now you've got the dollar index. The dollar index is first off overbought. It is not embedded. It's the first day, though, where both the K and the D line, the two numbers that make up this momentum oscillator, are over 80. When they first get over 80 together, they're still overbought. You need several days in a row of that to convert it from overbought to locking in and saying this market's even building more power and the bulls will be aggressive. I'm talking on the breaks. You haven't done that. You're just overbought with a pattern of a higher high, lower low. I look at it, the market failed to get up to the upper Bollinger Band, and this area of resistance that I know I've pointed out on these tapes is still showing itself. That does not mean it can't be taken out. The bias is up, overbought condition, and you're out of a trend. That's my definition. In the euro currency, we have a market that's got both numbers under 20. Now let's take a look. You can see that right here. Yesterday, both numbers were under 20, not the day before. So the key is, if you're going to get bearish here, tomorrow is the day that you have to keep both numbers under 20. More times than not, you will get overbought, you will get oversold, and turn the other way. So for the bears, it's a low probability that it will continue to do that. But if it embeds, then I don't care that you've got the higher high and lower low. The slow stochastic reading embedded takes over the chart. That's my theory. Right now, I see neutrality. In the British pound, tell me that you don't play at this 18-day average of closes as you're trying to figure out what next. And I don't think anybody knows what is next in Brexit. I know that Jeremy Corbyn and Prime Minister May, two opposition people, if you will, got together today and said they're going to have negotiating teams get together. I don't know what they're negotiating other than they either got to get something through Parliament. They hate each other. And the question is, if they can get it, what is it that the EU will accept? I mean, you're running out of time. In the Japanese yen, excuse me, my eye starts with oversold. I have terrible allergies at this time of year. It's not a cold. You won't catch it. Lower highs, lower lows. Outside day down after this break. So, does the market make its run to the lower Bollinger Band as support? If it takes out today's high, either on Thursday or Friday, I call that a bear trap, and it puts into play the probability that the market's going to try to get a bounce back to the 18-day average. Doesn't mean it has to, but I call that a bear trap. So I think the bears, do they get aggressive while you're oversold? A rough chart. Bitcoin, gone. Now, I had the June up, but I looked at the volume. It's not enough. We should follow the April, even though a lot of people don't even trade Bitcoin, but I like to follow it at least. It gives you an idea what's going on. And take a look. Both numbers are over 80, both over 80. And I can't even get to that day. I apologize. It won't let me get over there. I'll try to come back. Will it? Nah, not enough days there that it'll go back. I wanted to get to one more day to see if it had embedded. I don't know if it did or didn't. In the Brent, look at how the spread keeps coming in. And as you're going up, now today you close 69.31, literally right at the upper Bollinger Band, but we have to say it's still 4 points over it. Yesterday, the market was over the upper Bollinger Band. The day before, that's 3 days in a row. That's a lot. Will the market get a fourth? Well, the probability of that is 98% of the time, no. 2% of the time, yes. I count each consecutive day, it's my own rule, that it is over or under a Bollinger Band is one of those 5 percentage points. And your answer should be, Ira, what happens if it hits 6? C'est la vie. More times than not, it won't. And it's just probabilities. First of all, are we telling anybody to go short up there? That's not how you use Bollinger Bands. I think that what's happening is money is saying to itself, maybe it's too high, and they're taking money off the table, and that's why it's not advancing much. Sort of stuck here in overbought area as well. WTI is stronger than Brent. It has what? Both numbers over 80, both numbers over 80, both numbers over 80, both numbers over 80, both numbers not over 80, right here. But if we go back, over 80, not. So where the market decided was right here what to do, and from there it's gone up and re-embedded. So on the pullbacks in the market, and I want to use the word very carefully, the pullbacks, I expect to see continued buying in this market until you lose that embedded reading. Gasoline, back to its upper Bollinger Band, a resistance area, not embedded yet, just overbought. In nat gas, this is that funny time of year, I keep telling you that. It's neither hot nor cold enough to get a big draw on gasoline, and that puts a bit of pressure on the market till we see the warmth come in, and then of course we start talking the air conditioning demand and so on. Yet there are parts of the country that we are seeing spikes in natural gas prices in the Northeast and so on, where it's been unusually cold. So keep that all. You always got to look at the big market and then your little regional markets. This is how the big market, we're trading not the regions, we're trading in the nat gas futures, the big market. Still bearish. The market is right now trying to do what? Well, both numbers under 20, under 20, under 20. So you're embedded. If and when you get the red line over 20 on a closing basis, it might be a sign that price and these two averages want to come together. Got it? So I would expect then that that could be the trigger. Remember, I'm having my webinar tomorrow. I hope you come. You can't just show up. You've got to get the invite, and if you don't get it, you're not going to be able to get in. The invite is for free. Call my staff at 866-973-2077. Begins 12:30 p.m. Central Daylight Time. Ends at about 1 to 1:15 in the afternoon. We'd love to have you there. Bring your questions, the symbols you want me to cover of whatever market it is, questions about indicators. I'll do my best to answer it. I'm Ira Epstein. Have a great day. See you tomorrow.